From downtown Milwaukee, welcome to Money Talk with Bob Landis. Each week, professional advisors from Landis & Company Investments discuss the latest financial developments, offering timely insight and long-term perspective.
This is Money Talk for May 30th, 2025. Let's check the calendar. Festa Italiana has found its way back to the Summerfest grounds, and they'll be there for 3 days starting today. It's time for a cannoli or 3, isn't it? And there's West Allis a la carte this Sunday from 11 to 5 in downtown West Allis, or Stallis if you're local. And the Brewers are on the road this week in Philly and in Cincinnati. Then they're back home next weekend with the Padres. Let's start off the silliness in the state of Florida with a very PO'd Muscovy duck. The duck has been chasing and biting people in the neighborhood and even sent one person to the hospital. The duck let's call him Donald, is protected by federal law and can only be removed by humane methods. I'm guessing a burlap bag and a big dog don't qualify. Here's another OpenAI story that gives us a clue that the machines are taking over. The latest ChatGPT model ignores basic instructions after each test run. It refuses to shut itself down. Then it rewrites the shutdown script and prevents itself from being switched off. Like we're in the Twilight Zone. And finally, a man in Australia purchased a $500,000 house just by recycling cans and bottles for 7 years. The Aussies have a program called Return and Earn, and after 7 years of recycling, his haul is $65,000. That's a healthy down payment on his house. But it doesn't stop there. He furnished his house with treasures found on the curb, like a refrigerator, microwave, juicer, bed frame, and more. Now, I don't know for sure, but my guess is he's single. On the podcast today, we have Art Rothschild, John Sandstrom, and Joel Driesang, and wrapping up the week, here's Kyle Tadding.
Well, thanks, Max. A good week overall for stocks, capping a good month. The NASDAQ up 1.9% this week, closing at the bell at 19,100. The S&P 500 also up 1.9%, closing at 5912. The Dow Jones Industrial Average closing at 42,270 on the week on Friday, up 1.6% in the 4-day trading week. For the year, NASDAQ down 0.9%, the Dow down 0.2%. The S&P now back in positive territory on the year, up 0.9%. Art, maybe that's the place to start, putting the cap on the best month we saw for stocks going back at least to November of 2023. Really, we haven't learned much. Maybe we have set aside some of the problems that were going on early in April, but I don't think we have a lot of new information, and yet here we are back on positive track for the S&P.
Yeah, it says something about money, I think, and to be more specific, the amount that's out there driving stocks higher. So when you look at this roller coaster ride, and I commented on this in our notes previously, a couple months ago I was on the show at the beginning of April as we were had faced down Liberation Day. The markets hated it, and stocks got clobbered. So instead of being down about 4 something when we ended March, into early April, we were probably down about 14% midway. By the end of the month, we were down just a fraction because the president scaled back on his tariff demands. Okay, then we get into this month with the market having been down 5% based on the S&P as of the end of April. Now we are for the year up 0.5%. So we had, as you just suggested, a tremendous month. But not only did we not learn much, as you mentioned, we didn't earn much. We went on an interesting ride. So anyone who doesn't like the ride might take this as an opportunity to get off the ride if they can't stand it, or adjust their portfolio so they get a better ride, something that's more to their liking or more appropriate for their risk tolerance. So this is a great lesson in volatility. And the unfortunate truth is, I think it's going to continue. I see no reason to think that we're done with this type of volatility. As you indicated, we don't even know. The Fed doesn't even know what's going to happen next. So they don't even know whether to raise rates, lower rates. So in the meantime, they're just going to keep them the same. There's plenty we can talk about there if we want to. But I will end my sermon with that comment. Fasten your seatbelt because the ride isn't over, and I think we should expect continued volatility, for the rest of the year and beyond.
I think that's fair, and I think it's a message that we've been communicating since we saw some recovery from those lows. You've got, for most balanced investors, a portfolio that's meaningfully outperforming broad measures of stocks, especially some of those riskier areas of the market. And that has a lot to do with the fact that, your bond yields on the year have gone down somewhat substantially, depending on how far out you're looking. But 10-year Treasury down 16 basis points, the 5-year Treasury down 40 basis points. You're talking about a bond portfolio now that has a tailwind, not to mention it had some pretty compelling yield advantage relative to stocks, relative to just about anything else out there. You were getting some pretty good income on high-quality investments. And so I think when you add in that the non-U.S. piece of our portfolio has also been outperforming, that some of the more conservative value stocks have done a little better and with certainly a lot less volatility, well, all of a sudden that balance that didn't work for the better part of the last 2 or 3 years is coming around and making investors who stuck to it and who were patient and waited out some of the lows, it's making them look pretty smart. And then to your point, I think it gives us the opportunity to say, okay, what should we do now? How did we feel coming through this? How do we feel about where we're headed? What have we learned? And as a result, what should we do differently in our portfolios? And John, I know in a lot of your conversations, that comes back to a conversation on allocations. We talk about right now, do we want as much allocated to the stock market, and especially the U.S. stock market relative to where we were maybe a year or two ago? I know we've talked at length in our investment advisory meetings about the role that international stocks are going to play going forward. And I know you have a number of conversations with clients on that. What are you telling them about kind of allocation overall right now?
It's an important conversation, and like you said, we talk about it pretty much every single week. But the market's expensive right now, and I think that's been pretty consistent for a while now. It continues to go up, even though it is expensive. Some things are more expensive than others. Me and Joel were actually talking about this a little bit earlier. Is you look at the performance of the Magnificent Seven, right, which is the high growth stuff. In 23, it was up. Those 7 stocks were up about 75%. Last year, they were up about almost 50%. But then you look at this year, they're down by 5%. And they make up about 35% of the entire S&P 500 as far as market cap goes. And that shows where the allocation and diversification comes into play to, as Art always says, smooth out the ride. The growth side of things is about as expensive as it can get. If you look at the traditional PE over the past 20 years is around 21. We're floating around 27.5 right now in the U.S. You look at international stocks, their average PE is about 13, I think, right around there. I think right now they're floating around 14. Much, much less expensive. They have a long way to grow. Most of the returns that they've seen this year have been from currency fluctuations, not necessarily performance of the companies. So that's definitely something that we're looking at as being a less risky alternative to pouring more money into U.S. equities.
And I think when you add in the tailwinds from a falling dollar so far this year, the potential for the dollar to weaken a little more, and then certainly the impact of tariffs on global trade. We have a world that is looking to our economic policy to get a better understanding of how do we navigate trade in a way that reflects how the U.S. is going to impart tariffs, how they're going to impart other kinds of potential taxes. And does that mean that maybe certain types of trade now cut out the U.S., where in the past maybe it was dependent upon some of our bigger banks to finance purchases or dependent upon some of our companies maybe for the technological aspect? You might see more of that trade transition towards non-U.S. businesses in a way that is intended to get around a lot of the impact that we're seeing from these issues. And so, Art, I think as we look at kind of, the big picture and where those stocks play a role in our portfolios going forward, certainly valuation's a big part of that, but what else are you kind of looking at for clients as it relates to how you build portfolios right now?
Yeah, I'm looking at the international stuff quite a bit. You introduced a new fund into our portfolio that's on the value side, on the conservative side of international. It's something you and I have talked about for years. There's another fund you and I talked about a couple weeks ago that I've been using. So clients, with the concerns they have about the U.S. market as well as overall trade, seem to like the idea of adding a little more international. I think we've been deliberately light because the foreign stuff is underperformed. And there's an article in the Wall Street Journal, this week that talked about what John just talked about. The PEs are lower, but it's been because the growth rates of their earnings have been lower. And that's why investors are still attracted to the U.S. market. So I do like adding more foreign. When we talk about bonds, I like short-term bonds. Interest rates are going up and down. The market's had concerns a couple times this year about rising interest rates. On the political side, deficits. This new tax bill is going to raise the deficit, and that could cause interest rates to go higher. And so I think investors have every reason to be concerned about higher potential interest rates. And so I want to keep duration, pretty short. But my favorite one this week was the taco trade. And the president didn't like the fact that somebody came up with the idea that the president, Trump, always chickens out. That's the taco trade. And he bristled at that, and he said, no. He's using tariffs as a negotiating tactic, which comes back to your question. How do we know what the net end result is going to be of all of this? Because no one knows. And quite frankly, I'm not sure we can really alter the course of trade simply by threats of tariffs. Not to mention the long-term cost of higher tariffs around the world means that theoretically we could have lower GDP growth, for the foreseeable future. But nonetheless, because there's so much money out there, I think stocks could continue to move higher because there's, even higher inflation can result in higher earnings, more money to spend, and people plowing more into the stock market. So I'm still cautiously optimistic, as pessimistic as I might sound.
I appreciate the taco trade moniker because our president's normally the one that comes up with some of the better nicknames. And so it's interesting that they've gotten something, I think, to stick on him. But, certainly it is reflective of, I think, the uncertainty that's out there right now. And then you add in, the conversation on interest rates and Jay Powell meeting with President Trump this week. I think there is a lot of concern about the politicization of our Federal Reserve. How much are they going to depend upon what politicians are pushing versus what they think the right answer is? I was encouraged this week, and Art, I know in your notes you mentioned it as well. I was encouraged by the fact that at least for now, Powell didn't back down. And as we kind of navigate an environment in which the Trump administration has been clear, and the president specifically has been clear, hey, we want to see lower rates, well, Jay Powell and the Fed have said, yeah, but hang on, because until the economic indicators line up in a way that would necessitate it, I'm not sure we need to be doing anything different. And then, Joel, we got plenty of economic indicators this week that probably tell us a little bit more about what that looks like, in particular, some data on personal consumption expenditure, both looking back to the first quarter, a little bit of a refinement in the GDP report, but more relevant is probably the April look at personal consumption from the personal spending report.
Right, and you can credit the Fed or not, but we're back now where the inflation rate is essentially where it was about 4 years ago. So before the Fed stepped in and started raising interest rates because inflation was so high, it got up to 7.2% in mid-2022. And today's report from April shows it at 2.1%. Besides September, that's the lowest it's been since February of 2021. And it actually matches up the consumer price index is also about at a 4-year low. So that one indicator looks pretty good, but there are all sorts of complications, of course, that suggest that maybe things aren't as rosy as they are. The one in today's report again on consumer spending, which we always say is 70% of the GDP of our gross domestic product. Spending slowed in April, and it slowed in the first quarter, as we saw in the GDP report on Thursday. And it's that we have to be concerned about. We don't know if it's, those are just one report, one period of reports. So we don't know whether that's something that's a longer term concern. But the fact that people are not spending as much and saving more, it's that savings paradox. It's good to save, but it's not good for the economy. Whether that's a greater concern, we'll have to watch.
And perhaps some of the sentiment and confidence numbers have led to some of that increase in savings. And, you look at households maybe a little bit more concerned about where things are going. Well, yeah, I'm going to save a little more for that potential rainy day. The latest consumer confidence number, maybe not quite as bad as it had been. But, still signs as you look at both confidence and sentiment that there's some concerns out there.
The first 4 months of this year, confidence and sentiment among consumers was dropping and precipitously. And the latest readings show that they've stayed the course as far as the month before. And part of it is the on again, off again, negotiations of tariffs, and and this week we're not only getting nations involved, but we're getting courts involved to say, no, these are going to happen, no, these aren't going to happen, and so there's a lot of confusion there. But the consumer sentiment report in particular shows that consumers are really concerned about tariffs, and they think that higher tariffs are going to mean higher prices, and they don't want that inflation that we had 2.5 years ago. So they're, being a little more cautious.
It's funny you mentioned getting courts involved in a lot of these conversations. The headline I saw today was that it's a small wine importer that seems to be the reason why the tariffs were temporarily paused, and questioning whether or not the president had the executive authority to impart them. And I think it's just one more reminder that you don't get between a drinker and their glass of wine because they'll take you to court. I think that's probably enough for a 4-day trading week. The economic data certainly this week pointing to more of what we've known, which is a lot of mixed news. We've got a lot more on tap next week. And as we get settled into summer, I think there's plenty to pay attention to, plenty of headlines that need some resolution. But for now, we enjoy doing the program for you. We'll talk to you again next week.
Thank you for listening to Money Talk with Bob Landis. If you have a financial question you want answered on next week's show, email it to moneytalk@landis.com. To keep informed throughout the week, visit our Money Talk page at landis.com.